If you watch the final 15 minutes of a trading session, you will see a surge of high-velocity trades and rapid price swings until the clock hits the daily cutoff and everything suddenly stops. Starting August 3rd, the mechanics of those final 15 minutes are being entirely rewritten. The Securities and Exchange Board of India is implementing a mandatory structural update across the market. This directive strictly targets eligible futures and option stocks. If you are trading equities outside the F&O segment, your session remains completely unaffected. For those F&O stocks, the exchange is abandoning its continuous trading moving average model for calculating end-of-day prices, replacing it with a discrete, option-based matching system. This technical update fractures the traditional intraday schedule, creating a split timeline that both algorithmic platforms and manual day traders now have to navigate. The morning bell will still ring at the exact same time, but the closing sequence is now divided into multiple staggered cutoffs. To trade accurately under these new rules, we need to map out the revised schedule and examine the mathematical flaw in the old system that forced regulators to act. This chart breaks down the final 45 minutes of the new trading day. We now have 3 separate categories of assets, each operating on its own clock. First, the regular cash market trading for F&O segment stocks ends exactly at 3:15 p.m. Second, equities outside that segment continue to trade as usual, carrying on until the traditional 3:30 p.m. cutoff. Finally, the derivatives market itself, the actual stock and index F&O contracts, will remain active until 3:40 p.m. These staggered session times directly dictate how brokers handle intraday risk management, specifically their automated square-off protocols. If you are using margin intraday square-off products for stocks moving to the new closing auction system, your broker will force close your position at 3:10 p.m. For stocks outside the auction system, that forced cutoff stays at 3:20 p.m. And for the F&O contracts themselves, positions are automatically squared off at 3:25 p.m. Managing 3 separate closing clocks is the new reality for day traders. This fragmentation is a direct result of regulators fixing a structural vulnerability in how the final price of an asset was calculated. Before this mandate, the market determined a stock's official closing price using a moving average formula. This time series graph plots trading activity from 3 p.m. to 3:30 p.m. The system isolated this specific 30-minute continuous trading window to find a fair end-of-day value. It calculated the volume-weighted average price, or VWAP. As you can see, this indicator factors in both the execution price and the total volume of every trade, keeping it close to the median as long as market volume remains steady. The math works cleanly in a balanced environment, but continuous moving averages break down when they encounter sudden extremes in liquidity. Watch what happens to the average if a massive block trade is executed in the final 60 seconds of the session. Because the formula assigns weight based on volume, this single transaction acts like a magnet, dragging the average violently away from the day's median price action. Knowing exactly how this formula behaves, participants with large capital reserves could intentionally flood the market at the last second, forcing the official closing price upward or downward to benefit their positions. Calculating the closing price while trades are executing live mathematically fails to protect the asset's true value from sudden localized manipulation. To eliminate this exposure, regulators have replaced the final window of continuous trading with a closed environment. This is the closing auction session. It activates immediately after the regular cash market comes to a hard stop at 3:15 p.m. for F&O stocks. Looking at this order book diagram, you can see how the auction works. Bids and asks enter the system, but the matching engine suspends execution. The orders pool together in a holding zone. The exchange blindly aggregates these unexecuted buy and sell requests across the entire auction period, graphing total market supply against total market demand. Instead of processing trades sequentially, the matching algorithm evaluates this aggregated data simultaneously to calculate exactly where the highest volume of shares can change hands. The exact point where those two curves intersect yields one specific number, the single market clearing price. That mathematically derived intersection point becomes the undisputed official closing price for the stock. If a massive buy order drops in at the very end of an auction, it does not yank a moving average. It just gets absorbed into the aggregate demand curve, heavily diluting its ability to skew the result. Transitioning to a discrete auction system filters out high-frequency trade anomalies, ensuring the final price accurately reflects the genuine supply and demand of the broader market. Getting this specific number right is critical because the closing price is the single most important mathematical input in the entire financial ecosystem. First, it dictates the valuation of national benchmark indices. Every movement in the Sensex relies entirely on the precision of these end-of-day calculations. The Nifty 50 is equally dependent on that single market clearing price to accurately reflect the health of the Indian economy. Second, institutions use these prices to lock in the daily net asset value for massive mutual funds and exchange-traded funds, directly determining the worth of retail investment portfolios. Third, it controls the final financial settlement for every daily contract executing in the derivatives market. Millions of trades settle based entirely on this one variable. By implementing this system, India is actively aligning its market infrastructure with the mathematical standards already proven across Western financial centers. The world's largest equity market currently relies on these exact discrete auctions to secure the integrity of its closing prices. Major European financial hubs utilize the same matching algorithms for their end-of-day processing. If you are a long-term investor holding a passive portfolio, this structural upgrade happens entirely behind the scenes, protecting your assets without requiring any action. But if you actively trade intraday, ignoring the new 3:15 p.m. timeline and the mechanics of the auction session means you are operating blindly inside a re-engineered market.